In this video, I want to talk about coverage call writing. What is coverage call writing? Coverage call writing is the case where an investor owns the stock and then writes a call against the stock. Why would you want to do this? Well, one reason is that the call premium you receive for writing the call option generates income. And this can be a great way to enhance the return of your portfolio. Most of the time, the option is not going to be exercised against you, so you're going to be generating income. And you'll find lots of wealthy investors will do this all the time. They'll have their brokers write these covered calls. Every once in a while you may have to pay off, but most of the time the option is going to expire worthless, and you'll simply collect the premium. Another reason you might want to write covered calls is that it'll cushion a loss if there's a drop in the market. So it's a useful strategy for investors anticipating a drop in the market but unwilling to sell the shares now. Why might you be in that position where you're expecting the market might fall but you really don't want to sell your shares? Well, for example, suppose it's December and you're planning to sell the shares of your stock, which happen to have a large capital gain, and you're going to use the proceeds in the coming year to buy a house. Well, if you sell in December, you're going to have to pay that capital gains tax on April 15th. So you have about 3.5 months to pay the tax. If you can wait until after the new year, you'll get a whole another year before you have to pay the tax, so you won't have to pay for 15.5 months. So there may be a reason for postponing the sale of your stock. So let's take a look at some payoff diagrams here. If you buy the stock, or you have a long position in the stock, and let's say you buy it at 79 and 7/16, what's your break even? Your break even is 79 and 7/16, the price you paid for the stock. Stock price goes up, you make money. Stock price goes down, you lose money. If we assume that you paid cash for this stock, that you didn't buy on margin, the most you can lose is 79 and 7/16. That is, you bought it for 79 and 7/16, the price goes to zero, it's worthless. That's how much you can lose. Now, there's no limit to how much money you can make, and that's why we have an arrow pointing up, because the stock price could go to $1,000 a share, $10,000 a share. If it were a stock like Berkshire Hathaway, it's over $170,000 a share as I speak. Now, it took a long time to get to $170,000, but theoretically there's no limit to how high the price of a stock can get to. Now, what does a payoff look like for writing or selling a call option? Suppose you sell an 85 call at a price of $5. Well, you receive the premium. And remember, what you're doing is you're giving someone the right to buy the stock from you for a price of 85. Now, as long as the price is below 85, nobody's going to exercise that option, because why would they pay you 85 for the stock if the stock were selling for 75? They just go in the marketplace and buy it for 75. So you keep the premium, okay? The option expires worthless. For every dollar the price goes above 85, you lose $1. If it goes to 86, you're going to have to buy it for 86 and then sell it to somebody for 85, so you lose $1. The break-even point here is 90, because at a price of 90, you have to buy it at 90, you sell it for 85, so you lose $5, but keep in mind that you received a $5 premium, so that's your break-even point. And again, you can see that there's no limit to how much money you can lose. That's why we have the arrow pointing down, because the stock could go to, $1,000 a share or $10,000 a share. So there's no limit to how much money you could lose. So this is a very risky strategy. It's sometimes referred to as naked call writing, because you don't own the stock. So if you have to deliver the shares, you're going to have to go out in the marketplace and buy the shares at whatever price they're selling for. Now let's combine these two diagrams and see what it looks like for covered call writing. This blue line here is your long stock position. This is your payoff that we had before, right? Break even is 79 and 7/16. Most you can lose is 79 and 7/16. etc. Now, if you write a covered call, you're going to receive $5, a $5 premium. And that's the vertical distance here. This is a vertical distance of 5. So what you've done is, the worst you can lose now is 74 7/16 if the price went to 0. Because you would lose 79 7/16 on your stock position, but you received a $5 premium from your from the option you sold. And these should actually be negative numbers here. You'll see that the break-even point, instead of being 79 7/16, is 74 7/16. So what you've done is you've lowered the break-even point. So if the stock price falls a bit, you're still going to break even here. Now, what's the downside? The downside is, once you get to a price of 85, remember that the option will be exercised against you. And so for every dollar you're making on your long stock position, you'll be losing $1 on the option that you wrote. So your payoff is just going to flatten out here. In fact, this looks like the same position of writing a put option. As long as the price of the stock stays below 90, you're better off having written covered calls, because notice the red line, the covered call payoff, is above this line here, which is the long stock position. Once the price of the stock gets above 90, then you're worse off having written the covered call. So, most of the time, if the stock were hovering around 85 or so, most of the time it's not going to shoot up that much over a 3-month period, so you're usually going to get to keep this premium. You're going to make some money. So this is why a lot of people engage in covered call writing. Okay? In addition to protecting yourself from a market downturn, it's just a great way to generate this $5 of income, which is this vertical distance here.